Well, we mentioned earlier we've been watching shares of Corus today. The Canadian media company's bottom line performance showed improvements as Corus has been focused on controlling its costs. What has been difficult to control, though, is the current advertising market. Weakness has weighed on the company for some time, and that uncertainty lingers. In addition, the Hollywood strike we had covered complicated things in the industry. While that dispute has now been resolved, it did delay the release of some newer content. For more on the state of the industry, we're joined now by Doug Murphy. He is the president and CEO of Corus. Doug, thanks as always for joining us.
Happy to be here, John. Nice to see you.
I mean, how would you characterize the state of affairs right now?
Returning to normal would be the first thing I'd say. I mean, the strikes, of course, caused the whole industry, both streamers and broadcasters, to have a void of content. And we're actually very excited to have a full schedule coming back in March. It begins to come back a little bit in January. We have 17 hours of simulcast as of mid-January, warming up the time slots for the full schedule in March. And I think the whole industry is breathing a sigh of relief that we can at least get our audiences back. And now we just have to get the advertising recession behind us.
Yeah, I mean, what's been the response from the advertising community to that new programming?
Well, we're seeing from CMOs that, you know, the brand advertising has been kind of set aside over the pandemic and over the recession in favor of kind of bottom of the funnel digital conversion-driven advertising. But brands need to be front and center in front of audiences and consumers. And so we feel like with the advent of some big, fan favorite returning hit shows on television, we're going to see some returning investments in brands because you still can't beat the reach and frequency of television if you're a CMO to get your brand in front of audiences.
In the short term, you've had to keep a lid on costs. You're controlling costs. We saw that reflected in your bottom line performance. What have you been doing and what might you continue to do? What's the strategy going
We've
forward?
been operating underneath the focus of control what you can control. And, in that regard, we have launched a program called Fit for the Future, which is really about rationalizing our asset base and streamlining our operating model. And so we have done significant work on trying to get much more efficient to focus our core activities. It's involved a lot of restructuring, a lot of exits of employees and closing of positions. But that's required in this day and age because we need to get lean. And the outcome, when we get the inevitable return of advertising dollars, will be a P&L that's geared for a nice operating margin. And you saw it in the results today, 33% overall EBITDA margin on revenues that are down. That's a function of a lot of cost control. In fact, our total operating costs were down 17% for the quarter.
And, I think last time you were with us, you were talking about the conversations you've had with regulators as well. It's no secret. You had said to the CRTC, look, there's a challenge for us in committing to spending on Canadian content at a time when there's a lot of challenge for our industry. So what's that dialogue like right now?
Two items there. One is, the other thing, in addition to having a normal schedule from foreign programming supply, we finally put this excessive Canadian programming spending obligation behind us. So when your prior year revenue, is here and next year you're here, your obligation is 30% of the higher number. So your effective Canadian programming percentage is 36% for us this year versus what it should be is 30%. The snake has finished swallowing the pig, so it's gone now, pardon the metaphor. And so we have now a much more improved Canadian spending level. As far as the Ottawa regulatory conversation is concerned, the CRTC is moving through its first proceeding to determine how the foreign internet broadcasters will contribute to the Canadian system. And what we continue to advocate, and I said it on the call a moment ago, is leveling the playing field means getting contributions from the U.S. streamers and then reducing our contributions and giving us more flexibility for the Canadian industry such as Bell Media and Corus Entertainment.
I mean, I think we'd all like to see a very robust Canadian media landscape.
Indeed,
I'm part of it, and I would like to see it, but the dynamics are challenging when there's, digital media companies are quite literally technology companies that you're competing with. I mean, we did see that deal on the news front based on the battle that had been playing out between Ottawa and Google, for example. So your businesses would be getting some of that money from Google going forward.
Yeah, well, so some of it. I mean, of the Google contribution of $100 million, 30% was set aside for broadcasters. And I won't quibble with that percentage. I think it should have been more, but our companies will benefit to some degree from that amount. But news, this year is Global TV's 50th anniversary. And we're still operating underneath regulations that were coined 3 decades ago. And news is what we do so well as an industry in Canada, and it should be worth a lot more than what we're getting for it.
How do you navigate all this as a public company? I think it was call it October, when we saw your share price dip below $1.
Yeah.
And you had suspended the dividend as well because you wanted to focus on debt payments. That helps you with balance sheet issues, but I guess there's lingering uncertainty in the stock market.
Yes.
So how do you navigate everything you just talked about, plus the fact that you have a pretty sizable digital transition roadmap? You've talked about it a lot, but you got to do it all in the public market forum, essentially.
Yes, and I think that we are Canada's only pure play media and content company that's publicly traded, and we're not part of a big distributor like Bell Media would be or Rogers Media would be. But you know what? We have a line of sight to where we want to go, and this print is demonstrating what we said we would do, and that is get lean and get efficient and get fit for the future. And when the revenues do return, we're going to see some nice results from the kind of flow through of our improved cost structure.
You had done some larger deal movement, just as you're sort of thinking about the landscape. You sold Toon Boom.
Yeah.
You had talked to us about that. How are you thinking about deals going forward?
I think at the moment our focus is on, again, what we can control. So we're moving from being a broadcaster to being an aggregator of premium digital video. We're building cross-monetization and targeting capabilities. We've got Pluto TV, which is now streaming 1 billion minutes a month, Canada's largest fast channel, free ad-supported streaming television channel. We're working to scale out the revenues there because we have the audiences. We have Stack TV, which is our 16-channel bundle on Amazon Prime Video, now on Bell 5 TV app, I'll add. So Stacked is now carried on 6 different distribution platforms. That's a channels bundle on a streaming platform, so it's a hybrid product. Those are 2 big growth opportunities for us we're going to continue focusing on.
Do you, like, is there anything in it? Because, look, a lot of people sign up for these U.S.-based streaming players, but increasingly those companies that are navigating their own headaches have been increasing their prices. You've already alluded to the fact that you think that there actually is an opportunity for you on price for streaming offerings.
Yes.
But are you seeing any traction on that?
Yeah, we are. So Stack TV remains at $12.99. And by the way, all of our 14 global news or fast channels are available on Stack TV. And the value proposition remains significant. 16 linear channels, 16 on-demand stacks. And all the U.S. streamers have raised their pricing. So we think that gives us a window to grow. We saw nice growth in Stack TV in the first quarter. It didn't show up in the subscriber line because it lags a little bit, but you'll see it in the quarters ahead.
Just a final broader question, because you're pretty up to speed on what's happening in Hollywood, and whether it's strikes or consolidation. There's reports on what happens, for example, to Paramount. Is consolidation broadly in the industry inevitable, in your opinion?
Completely. Globally, consolidation is inevitable because in order for the traditional studios to compete, they need to get more scale and find more efficiencies in their businesses to fund their balance sheets and to fund investments in production. They're up against, the big platforms, Amazon and Apple, Google. So, there are rules in Canada that make it a little more difficult, but I think you'll see consolidation in the States certainly in the coming year or two.
Okay. If you had to make one prediction for the media industry besides consolidation for the year, what would it be?
I feel like this is going to be a good year for the media business. I think we've been down and out for 18 months now, and it feels like we're putting in a bottom here, and the industry's responded with the right things to do. We're not losing sight of delivering great content for our audiences, building digital platforms, getting more efficient. So I'm feeling relatively encouraged about the year ahead.
Okay.